Hello everyone and welcome to the VA Home Loan Program video slideshow for home buyers. Boy, that was a mouthful. And just remember before we get into this that if you're watching this on the internet, you can actually follow along at your own pace. You can press the rewind button, you can press the pause button or the go forward button and follow along at your own pace. You can go make dinner and come back and pick up where you left off. So it's designed to really make it user-friendly to where you can really grasp what's being said, take notes, go maybe do some research online or call your buddies or whoever and not have to miss out on key facts just because we're not going at your pace. So having said all that, let's go ahead and get into this. You know, the VA Loan Guarantee Program is actually a benefit. Throughout the history of our country, it's actually been the priority of our government and the citizens to support those who protect and defend us as part of the military. And so all veterans who served a required length of service and an acceptable character of service, so there's two requirements there, can receive the benefit. It's not automatic and it's not guaranteed because there are some other restrictions, but typically if the veteran meets the length of service that's required and has a certain character of service, then the benefit belongs to him or her. And of course, the benefit of the veteran is the underlying principle of the whole program. Now, the VA may only guarantee a loan when it is possible to determine if the veteran has sufficient VA entitlement available. And that's a moving thing. That's a fluid thing that changes all the time. We'll get into that here a little bit later. And secondarily, a veteran must have a satisfactory credit risk or must be a satisfactory credit risk. And of course, the veteran must have present and anticipated future income that's sufficient for paying the loan back and also for other living expenses that are customary and normal for any household, even if the veteran is a single person. And of course, as we begin talking about the benefits of a VA loan, the very first thing that comes to mind is that it does not have a down payment requirement. The veteran can literally get into a home with no down payment. He or she can get up to 100% financing up to a certain loan amount, which in the last 4 to 5 years has been $417,000 as I record this in the year 2011. Secondarily, the VA Home Loan Program does not have mortgage insurance. This makes it very different to FHA financing or conventional financing above 80% because all of those programs have mortgage insurance, which of course adds to the payment. The beautiful thing about the VA loan is there is no mortgage insurance even at 100% financing. Historically, the VA has been a little bit more lenient on credit and employment history. There's a lot of flexibility there that you would not find in conventional financing underwriting. And so a lot of times a veteran would find a VA loan easier to qualify for than a conventional loan. There are no reserve requirements. What does that mean, reserve? The veteran does not have to have any minimum amount of cash in the bank. Even if the veteran has no money in checking or savings or retirement, he or she can actually get a VA loan without having to have any cash in the bank over and beyond what's needed for closing. And a lot of times, a veteran can close without any money at all. You know, the VA loan program allows automated underwriting as well as traditional underwriting. What is automated underwriting? Automated underwriting is a scenario where the underwriter, the physical person, relies on the feedback or we call the recommendations of a pre-built computer program that actually is tied to the amount of risk or the risk level that the VA is willing to take on. So what the underwriter does is input some vital information about the veteran, such as, you know, income, credit, a credit report, assets, employment history, obligations, all that good stuff, and then relies on the findings of the computer program to determine whether that veteran is eligible for financing or not. Now, it's very common that a credit report of a veteran might have inaccuracies or outdated information on there, and this would make an automated decision flawed. And in those cases, what the underwriter is able to do is lean on more traditional, old-fashioned underwriting, where they look at the history and the pattern of how debts are paid back and the strength of employment and so on and so forth, and the underwriter is able to make a determination in a more traditional manner. In both scenarios, automated and traditional underwriting, the system or the underwriter is going to depend on information regarding residual income and, of course, the debt-to-income ratio, which we're going to get into a little bit later. The seller can pay off debt for the borrower, for the veteran. It's an incredible thing, and this is unique about VA loans in comparison to FHA or conventional loans. The seller can actually pay down or pay off debt for a veteran, enabling that veteran to qualify. We talked about the fact that VA loans are 100% financing, but in reality, the veteran does come in with a little bit of cash to pay for some closing costs. It's not very common that a veteran's able to close with absolutely nothing out of pocket. It does happen, but more than likely some money will be needed, for home inspection, appraisal, so on and so forth. And in those instances, all of those funds can be gifted. They don't have to be the veteran's own money. It can be gifted by a family member and sometimes even by the employer. VA loans require that the veteran be 2 years out from a Chapter 7 bankruptcy and 2 years out of a foreclosure. A Chapter 7 bankruptcy is a type of bankruptcy where the veteran got to dissolve or walk away from his or her debt. A Chapter 13 bankruptcy is basically a rearrangement of debt, or what we call a reorganization of debt, overseen by a bankruptcy trustee. In that instance, a VA can actually approve a loan as long as the veteran has shown that he or she has been making a timely payment for the past 12 months, the most recent 12 months since the beginning of the bankruptcy. Let's talk about the product types. What types of products are there with VA financing? There's a 30-year fixed, which is what is most common out there, a 15-year fixed. There's a distinction between a regular VA loan, which goes up to a $417,000 loan amount, and a high balance VA loan, which is pretty common in some of the high-end areas, such as Hawaii and certain parts of California, where we would begin to look at VA loans as high balance VA loans. Now remember that VA loans are only for owner-occupying buyers. A veteran cannot purchase a home with a VA loan without the intent to move in and occupy the home. These are not for investment homes, and they're not for second homes or vacation homes. Let's talk about the veteran borrower's eligibility. A veteran is eligible for a VA home loan benefit if he or she served in the Army, the Navy, the Air Force, the Marine Corps, the Coast Guard, even the Reserves or National Guard, and was discharged under conditions other than dishonorable. Now, the minimum duty service required during wartime periods is 90 days of active duty, and the minimum service required during wartime periods is 181 days of continuous active duty. Now, for members of the Reserves and the National Guard, it's a minimum of 6 years. And for veterans who serve less than the minimum time required, you might be eligible if you were discharged because of service-related disability. So you need to consult with your loan officer in the Department of VA to see if you're eligible. Now, an unmarried surviving spouse of a veteran who died in service or because of service-connected issues can actually be eligible for VA financing even after the veteran has passed on. So that's a wonderful thing for those that were married to veterans. It's a way for the federal government to continue their favor and benefit to you and enabling you to get into a home with zero down payment, even if your loved one, the veteran, has passed on. Now, only the spouse of a veteran is actually eligible to be a co-borrower on a VA loan. No one else can be a co-borrower. You can't have a brother, a sister, a parent, a relative, an aunt, an uncle, not even a girlfriend, a boyfriend, a significant other, cousins. Nobody else can be a co-borrower on a VA loan, only the spouse of a veteran. Now, two veterans can actually purchase together as well, and we won't discuss that at this point, but it is possible for two veterans that are not married to each other to purchase a home using their VA entitlements. Now, a spouse that's not going to go sign on the loan with the veteran for whatever reason is called a non-purchasing spouse. And we see this a lot. The spouse might have unacceptable credit history or is not working or has sketchy employment history, and so they're not going on the loan. Now, in this case, it is okay for the veteran to get the loan by himself or herself as long as the spouse's current credit report is looked at and any debt that's belonging to the spouse in terms of a monthly obligation is counted against the veteran in qualifying. Now, one more thing to remember about VA loans that are different to FHA loans, a co-borrower that's not going to occupy the property cannot be a part of the loan. So the VA loan is not for veterans who need a non-occupant co-borrower to help them qualify. Now, a very important thing that must happen during the loan processing phase is a certificate of eligibility, also known as a COE, must be ordered by the lender. Now, there are some more details you can get on this website to go take a look at how eligibility works and some of the general eligibility requirements. You can take a look at that at your own leisure. Let's talk about occupancy. We just got through saying that a VA loan is only for owner-occupying veterans. It's not for investments or second homes. Now, a veteran purchasing a principal residence must certify that they intend to live in the home. There's a certification document as part of the loan package, so be prepared for that. Now, If the buyer, the veteran, is on active duty, a spouse can actually certify occupancy. Now, single or married service members deployed from their permanent duty station are actually considered to be in a temporary duty status and are still able to certify intent to occupy. There's no, special need to have the spouse certify occupancy in those instances. Let's talk about property eligibility. What types of properties would fit with a VA loan? Any single-family residence, a condominium, a planned unit development, which is basically a single-family home in a preset neighborhood of homes. Even 2 to 4 units, a duplex or a threeplex or a fourplex, are eligible for VA financing. Remember, the condominiums have to be on the VA's acceptable list of approved condominium projects. Manufactured homes are also eligible as long as they have a permanent foundation. Now, there are certain restrictions if the veteran's purchasing a home that was recently acquired by the owner, the seller, and is being resold, typically for profit within 90 days of that seller getting the home. There are some restrictions, and, call our office to go over that. We won't get into that here and now, but be aware that, especially in this market, we're seeing a lot of flips where investors are purchasing homes and flipping them for profit, and that's okay with the VA, but there are some restrictions that we need to look at, and feel free to call us. What are the VA loan limits? Under the President Bush administration in October of 2008, the Veterans Benefits Improvement Act was signed, and it actually increased the maximum guarantee. Now, for all areas in the U.S. except for Hawaii and Alaska, the maximum guarantee amount is the greater of 25% of either $417,000 or 125% of the area median Freddie Mac Home Loan Mortgage Corporation loan limit for a single-family home in that county where the property exists. Hawaii and Alaska, the maximum guarantee is the greater of 25% of $625,500 or 125% of the area median loan limit for a single-family home in that county. Now, on this slide, you can see the maximum loan amounts broken down. And of course, as you can see with most lenders, the maximum loan amounts are affected by credit score. A lot of VA lenders now will require a 640 credit score. There are plenty of underwriting sources that will accept a 580 credit score. And in some instances, even below 580 if compensating factors exist, which we'll talk about a little later. There are no reserve requirements if the veteran's buying a home and borrowing less than $417,000. If the loan amount is above $417,000, then some restrictions come into play with regard to money in the bank. What is the maximum guarantee? The VA guarantee, or a combination of the VA guarantee plus the borrower's down payment or equity, must be equal to at least 25% of the home's estimated value, which will be documented by the VA appraiser. A fancy word for that is NOV, the notice of value. And so the maximum guarantee on a VA loan is actually the lesser of the veteran's available entitlement or the maximum potential guarantee amount that's shown below. If you look at this chart, you can see that the maximum potential guarantee is actually 40% of the loan amount with a maximum of $36,000, and then 25% of the loan amount with a maximum of $104,250, which is what it is in the year 2011. And we'll be talking about that a little bit more in detail as we go on in these slides. Here's an example of a VA guarantee. Veterans used $48,000 of entitlement on a prior loan, which may not be restored, and is purchasing a home for $425,000. Now, let's say for argument's sake that the county we're talking about here is Ventura County in California, where the county limit is $650,000. So the maximum guarantee allowed by the VA would be $162,500, which is 25% of the county loan limit. So the entitlement available to the veteran now becomes $162,500 minus the $48,000, giving entitlement amount of $114,500, which if you multiply that by 4, because remember that portion is 25% of the total loan amount. So if you multiply that by 4, the maximum loan amount allowed in this scenario would be $458,000. Now, since the proposed loan amount will be less than the $458,000, the lender will actually receive a 25% VA guarantee on the loan of $425,000, and there will not be a need for the veteran to put any money down. Now, this calculation is a little bit tricky, so if you didn't get it the first time, feel free to call the office and we'll be glad to talk it over with you one-on-one.